A downgrade leads to a sell-off. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, Morgan Stanley's Mike Wilson says buy the dip as Moody's strips the U.S. of its last AAA rating. President Trump's big, beautiful tax bill advances on Capitol Hill, but the legislation still faces obstacles. That downgrade, not the least of them. And the battle for AI supremacy ramps up again. Nvidia unveils a tech to stay ahead of its competition. Sonali?
We're looking at Nvidia shares this morning, Matt. We are taking a look at them, taking a dive at about 2.5%. This is along with the broader market, but remember, they will allow customers to use rival chips as part of their AI efforts to expand an ecosystem across data centers. They're also looking to buy a quantum computing company. We'll keep an eye on that.
All right, definitely going to be watching those Mag 7 shares. They're really a big reason behind the drop that we're going to see in equities today. Also, vaccine makers. They're among the few gainers this morning as COVID cases spike in Hong Kong and Singapore. Novavax just got full FDA approval for its COVID vaccine. So we'll be talking about them with our own Sam Fazeli today as well. Sonali?
And as Matt had earlier mentioned, Moody's is the last of the big three credit agencies to strip the U.S. from its top rating. Now, Treasury Secretary Scott Bessent took to the Sunday shows to explain that this isn't a direct result of the Trump administration.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. You know, we inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
A Morgan Stanley strategist, Mike Wilson, reacting to the credit downgrade by saying he would buy any dip in equities as long as the 10-year yield is above 4.5%. Let's discuss with Bloomberg chief correspondent of global macro markets, Liz McCormick. And Liz, I said, the downgrade is not the least of the problems that Trump has with the big, beautiful bill, but it is really the least. No one cares, right? I mean, we get a little dip in equities after a massive gain last week. We get an 8 basis point rise in the 10-year. I mean, that's nothing for this.
You're desensitized.
Yeah, well, I mean, yeah, the market isn't going nuts, but remember, we came into this in a backdrop where fiscal concerns were already top of mind for bond investors. So this adds to it. Like you said, 30-year went above 5% again. I mean, it doesn't help, Matt. So I think because obviously we had S&P downgrade the first time in 2011, we had then Fitch come in 2023. People knew this was eventually coming from Moody's, but it definitely makes the point that fiscal is top of mind. So I don't think you could just say, oh, whatever, But I do think Scott Bessent, in what he was saying, the market wants to see it actually happen. They won't listen to words anymore. The budget that's moving through the House, like you said, it doesn't look too pretty for the deficit outlook and debt. So that's what they're focused on.
And a lot of concerns about growing your way versus inflating your way out of a deficit. Now, I want to point out a chart that Torsten Slok was sharing at Apollo this morning. This idea that foreign buyers have already been reducing their purchases of longer-term treasuries. That 30-year in particular, that's now above 5%. How long does that continue? Does 5% not attract people?
Well, yeah, 5% has tended to attract people. And I would say, and I saw Torsten's chart, very cool. And he was talking at the auction bidding, right, at his gauge of foreign demand. I would say overall foreign demand in the whole Treasury market, if you look at the Treasury data, has kind of been coming down. It's about 30%, but it's not falling off a cliff. We're still seeing buying. So I think maybe we don't need to be that concerned, but this kind of sell America trade did get revived today, right, over the weekend since Friday. But it's not screaming, like Matt said. 8 basis points isn't earth-shattering, but I do think it does keep giving people pause. Is it worth buying the dollar? Treasury yields, do we want to catch a falling knife? No one wants the long end. Everyone likes, the middle of the curve, that kind of thing. So, and right now the Fed's doing nothing. So there's no kind of juice from the Fed cutting rates anytime soon. I see a lot of people saying they're going to cut again in December. So you're kind of in this middle ground here. And if this package comes out that, it's going to be deficit negative in a big way, the bond market still has a reason to stay away from the long end.
This is the problem. Maybe it's not a scream, but it is a slow bleed. Bloomberg's Liz McCormick, we thank you so very much for your time. Now, in Washington, lawmakers are closer to adding trillions to the deficit as part of Trump's so-called Big Beautiful Bill. 1B3?
1B3.
1B3. Now, the House Budget Committee advanced Donald Trump's tax and spending package after party leaders agreed to speed up cuts to Medicaid health coverage. Joining us now, Bloomberg's Tyler Kendall. Walk us through the House, but more so the Senate's reaction to what we're seeing right now.
Yeah, hey, Sonali. So while fiscal hawks in the House did get in writing these promised changes from House leadership when it comes to moving up the work requirements on Medicaid, as well as rolling back more of those clean energy tax credits that were implemented under the IRA, to be sure, at this point, the text of the bill hasn't actually changed and the negotiations are ongoing. While fiscal hawks perhaps were able to bolster their argument to colleagues amid the Moody's downgrade, at the same time, it really does remain to be seen whether or not they're going to get the sort of aggressive changes that they are advocating for. So for sure, both sides, the moderates as well as more of these fiscal conservatives, don't appear super happy at the moment as they try to reach some sort of agreement. I actually was on this program on Friday right after I had caught up with Chip Roy, perhaps one of the most vocal members of the House Freedom Caucus, who told me that he wants to see those Medicaid work requirements moved up immediately. That is something that is going to be difficult for the Senate to get behind, as well as put this White House in a politically fraught position. In fact, Sonali, I actually just caught up with the NEC director, Kevin Hassett, here at the White House, and I asked him if they would be in favor of moving up those work requirements, and he said that they would if that's what it takes to get the deal done, because at the end of the day, this administration really is banking on getting this reconciliation package through as soon as possible. House Speaker Mike Johnson says they're still on track for 1 week from today.
So just to be clear, we're looking to strip how many million people of Medicaid coverage?
Well, the estimates vary, but one analysis that we cite here at Bloomberg News could remove about 7.7 million people from those benefits by 2034. So it really is something that we are closely watching. As of now, as the bill is written, it would phase in those requirements through 2029. It appears the sweet spot might be to phase them in closer to 2027, but these members of the House Freedom Caucus are really pushing that they need to get that revenue raising from these spending cuts now in order to make way for all the other tax priorities that are rolled into this bill, not to mention that we are still waiting a deal when it comes to lifting the SALT cap. And these members of the House Freedom Caucus say they need to see more savings in order to get behind that.
Tyler, the president is going to speak with Vladimir Putin right now. And it looks like maybe Russia holds the cards. What do we expect?
Well, Bloomberg News is reporting that Vladimir Putin is going into this call feeling that he might have the upper hand. Our reporting indicates that Russia does feel that it can break through Ukraine's defenses by the end of the year. And we should say that Western assessments at this point do not agree with that. But perhaps it indicates to us that Putin isn't going to get on the phone with President Trump this morning and offer really meaningful concessions. There are a few different ones that we are watching here. Bloomberg News, Matt, as you'll recall, back in April was the one that ended up breaking that the U.S. was set to demand that Russia acknowledge Ukraine's right to build up its own military and defense industry, while Ukraine would abandon its goal to come into NATO, and that the U.S. was also prepared to freeze the battle lines where they are. So those are some of the threads that we're going to be following to see if there can be any movement here today. Of course, as you well know, Ukraine and its allies say that they need to see more firmer security guarantees from this White House before they talk about any sort of territory concessions. Matt, President Trump is expected to call Ukraine's president and NATO allies after the call.
Tyler, we appreciate all of your reporting. That is Bloomberg's Tyler Kendall reporting from the White House with a very busy day ahead. Now, some breaking news. Commerce Secretary Howard Lutnick sold his stakes in Cantor Fitzgerald. He's divesting the Wall Street business group that he ran for more than 3 decades. He is passing ownership to his children and private outside investors and cashing out at least hundreds of millions of dollars. Now, that private investor group includes Josh Harris. You might remember him as a co-founder of Apollo, now runs 26 North, which is leading part of that minority investment, as well as Glenn August, who is the founder of Oak Hill Advisors. Matt, a very interesting move here for a storied Wall Street firm on to new investors, including his own sons.
Cha-ching.
Cha-ching, that's correct.
Cashing in. All right, let's get to the Nvidia story.
In corporate news, Nvidia is going to allow customers to use rival chips in data centers built around Nvidia technology to expand its AI ecosystem. We're now joined by Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. What do you make of this move? There's a lot of things going on with Nvidia under the surface this morning. I'm going to want your thoughts on quantum computing as well. But this particular strategic move, how big of a deal is it?
I mean, this reminds me of what Microsoft did back in the day when they, launched Azure. They said, we are going to support all the different operating systems and not just Windows. So in this case, we know Nvidia has really ramped up the GPU side of the business. It's almost going to do $200 billion in revenue by the end of this year. And look, if they really want to integrate with the cloud providers, which are 45% of their business, they need to support the ASICs and the CPUs that other companies are making that Nvidia is not making. So clearly opening up the platform seems like a very sound strategy here.
I also see in the information that they're in talks to invest in quantum startup PsiQuantum. What's the story here?
I mean, look, I know Jensen, when he was at the CES, he said quantum is like 10 years out, or 10 or 15 years out.
This doesn't seem that long.
And clearly, there was a lot of backlash from the industry on that comment and the fact that, he wasn't thinking about it in the near term. So since then, they have backtracked in terms of holding a quantum investor day when they had the GTC. And look, in this case, clearly, Nvidia, now that they are such a big player in the data center market and everyone is relying on them, they want to be associated with every new technology. Why would they leave out quantum, even if, I would say the prospects haven't changed materially since the time he made the comment, but it makes sense for them to have the ecosystem with them. And I think investing in quantum computing is a bet probably for the long term here.
If you thought that Gen AI was a game changer, when we see it, you have to imagine that quantum could change everything.
Sonali is all about quantum computing, and I'm right there with you. Glad to have her watching it for us on the show. Mandeep, glad to have you commenting on Nvidia for us. It's definitely going to be a driver of the action today, maybe to the downside. It looks like the Mag 7 will be a real weight. You can see S&P futures right now down about 1%. The Mag 7 were a huge lift to the market last week. Remember, we were up 5% plus on the S&P. We were up 7% plus on NASDAQ 100 futures. So this little bit of a sell-off isn't going to bring us down too much. Coming up, vaccine makers, they're back in rally mode because COVID cases are surging in Asia. We're going to talk about that with our BI analyst, Sam Fazeli, next. This is Open Interest. Let's get to high interest now. A look at what's making headlines around the world. Former President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has metastasized to his bones. According to a statement from his office, the president and his family are reviewing treatment options with his physicians. Biden is 82 years old and left office in January as the oldest president in history. Israel's Prime Minister Benjamin Netanyahu says Israel will take over the entire Gaza Strip as the military carries out an unprecedented attack on Hamas. Netanyahu also said Israel would start allowing aid into Gaza, again, despite opposition from far-right members of the coalition who say it will help Hamas fund its war effort. Israel has been under intense international pressure to restart that aid. A report shows that about 1.6 million people in Gaza are facing food shortages. And New Jersey Transit reached a tentative deal with its striking union members on Sunday, but it's still a manic Monday for commuters. The deal didn't allow enough time for transit services to resume this morning. Financial firms like Citigroup and Deutsche Bank told employees that they could work from home or local offices. The leeway offers a partial reprieve from stricter return to office policies. Full operations are expected to restart tomorrow. Sonali?
And Matt, as you were mentioning before, makers of COVID drugs and diagnostic kits are climbing in U.S. pre-market trading. And that's on warnings from health authorities in Hong Kong and Singapore that cases are spiking. For more, we are joined by Sam Fazeli. He's Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. How significant is this uptick?
Well, it's not long ago that COVID wasn't doing what most respiratory illnesses do in the wintertime, i.e. just be confined to winter. In fact, right up to last year, there were two curves, spikes in the US. So one around the wintertime where all the other ones come along with flu, et cetera, and then another one about 6 months later, about this time of year. Pretty much a lot of it coinciding with people being more sociable, or when the summer hits, they go indoors with aircon, etc. And also the fact that your natural antibodies tend to wane a little bit over that period, so you're more susceptible again. So that's, I think, probably what's going on here. I don't think this is a particularly worrying thing. It's a bit early because I don't know whether summer has already started in most of Asia, but I don't think it's surprising to see these two peaks, and the US has been seeing it.
What do we know, Sam, about the Novavax approval? Is this for everyone? Is it only for people over 65? Are there stipulations? How does it look?
Yeah, so Matt, there's two groups that have been stipulated in the actual approval. And remember, this is a full approval. This vaccine has been under emergency use. Remember those days? Emergency use authorization, just like the mRNA vaccines. It just took a lot longer than them to get past this point of getting full approval. And in the end got it. And it is for 65 and above, and those at high risk of catching the disease in terms of their complications between the age of 12 and 64. So when you look at that group, those are probably the same people who've been taking it anyway in the recent past. So it's a good position for them to be in. Probably a little bit late to see major money flowing in from contracts. 2026 will be the year we'll see how effective it competes with the mRNA vaccines.
In a lot of ways, many people are anticipating COVID season, sort of like they would anticipate the flu. How much are people taking these vaccines? What does the uptake look like?
Yeah, so look, I think the uptake has been declining year after year after year. For whatever reason, is it the sorts of conversations that are being had by some people about, well, you don't need it anymore, we've got natural immunity, etc. But I think even amongst those who should take it, there is a small percentage. There's only a small percentage that do take it. Don't forget, flu has been with us for much longer, and it's still hard to push it past 30-40% coverage of those who will benefit from it. So it's a tough sell, this, getting vaccines to people where they need it.
All right, Sam, great to get the intel from you. Really appreciate it. Sam Fazeli runs our Bloomberg intelligence operations out of Europe and focuses in on pharmaceuticals. Let's get a quick check on futures ahead of the opening bell. We're still looking at big drops. S&P futures down 1.1%. NASDAQ futures off 1.5%. But remember, we had a fantastic week last week with a 5% plus gain on the S&P 500. Also getting headlines across from PepsiCo saying that it is going to complete its purchase of Poppy, which is a maker of some kind of, I guess, healthier form of probiotic soda. And you can see Pepsi kind of fighting the drop today with a little bit of a gain in the pre-market. We'll see how that goes at the open.
Yeah, but it's interesting. We've seen the sell-off get more stark as the morning went on. We were down less than 1% when we started this show.
That's right.
Where sentiment is today.
We'll come back and see what Sinead, Colton, Grant thinks about Mike Wilson's advice to buy the dip. She sees the S&P 500 finishing the year around 6,200, so maybe she's into it. This is Open Interest.
It is a fact that if you put the aggregate of the policies undertaken right now, most of the world wants to diversify in a meaningful manner while keeping a healthy exposure to the U.S. There's no way you can cut exposure to the U.S. and get respectable returns, certainly in the equity markets.
Venu Krishna of Barclays casting doubt on the Sell America narrative. Joining us now at the desk, BNY Chief Investment Officer of BNY Mellon, Sinead, Colton, Grant. Which side are you on here? Because it's interesting. We're seeing the market have that Sell America narrative come back into it. But you have Venu Krishna, you have Mike Wilson coming in saying this is a good time to get in.
Look, we've taken out a lot of left tail risk over the last 4 weeks. So actually, we're a lot more constructive. Our expectation of the odds of recession is now down to 25%. We see earnings expanding for the full year around 9%. So look, the S&P could, at the upper end, finish around 6,400, even higher than the 6,200 midpoint. So we like it.
Surveillance had Mark McCormick on this morning from the Toronto Dominion Bank, TD. And he was saying that one of the effects of this deglobalization, reindustrialization we're going through is that foreign investors will be taking money out of U.S. assets, taking their investments out of the dollar and looking for other things at a time when we need it most, right? That kind of investment. What do you think about that argument?
This is where I think you need to be really careful about traditional economic views overtaking what is the rational fundamentals, right? So think about productivity growth in the US relative to most other developed markets. It is at least double over the last 5 years. And that also extends back through for really the period since the financial crisis. So you think about productivity growth, you think about the innovation that happens in the US. I think it's pretty tough to bet against the US as a location for investment. Do you want to invest outside the US? Of course, because you want a diversified portfolio, but you certainly don't want to bet against the US.
Sinead, you're sticking with us. That is BNY Wealth. Sinead, Colton, Grant sticking with us through the open, just a few minutes away. But a check on futures ahead of the opening bell, because yes, we are down in the U.S. That Sell America trade, as you've been talking about, has been taking off a little bit this morning. But the NASDAQ 100 down more than the S&P 500 in terms of futures movement, 1.5% on the big tech index. Russell 2000 down about 1.7%. And the S&P 500 has been gaining steam in the slight sell-off. But as you've been saying, Matt, it was a good week before. Maybe people are just taking a few chips off the table.
Absolutely fantastic week last week. We closed at 59.58 on the S&P 500, so more than 200 points above where we were April 2nd.
6,000.
Okay, but we're still higher on the year. We'll come back with the opening bell. This is Open Interest. We are moments away from the start of trading on this Monday morning. It looks like that downgrade is going to lead to a sell-off. Is it a buying opportunity? A question we're putting to our guest today. S&P futures down more than 1%. NASDAQ futures off 1.5%. Small caps falling even further right now. You hear the opening bell down the New York Stock Exchange. An unfortunate ticker, UTI, ringing the bell there. But the shares are up 34% year to date, and they're up like 400% over the past 5 years. That makes up for the ticker they chose, Universal Technical Institute, worth about $2 billion and climbing. A $2 billion biotech firm, Ligand, ringing the opening bell at the NASDAQ. Shares are basically unchanged, I think down about 2% year to date. In terms of the stocks that we're watching, Sonali, you've got a big one here.
I do, and Nvidia down more than 2%. They will allow customers to use rival chips as part of their AI efforts in a move that's going to further expand its ecosystem across data centers. But shares are falling in line with broader markets this morning. And Matt, it's really big tech that is leading the way in that sell-off in the market today.
Yeah, I think Nvidia is just illustrative of the Mag 7 pulling the market down today. They pushed it up last week. Vaccine makers are swimming against the grain or upstream. I'm guessing mixing my metaphors a little bit, but they're up. After COVID cases spike in Hong Kong and Singapore, Novavax just got FDA approval for its COVID vaccine. So they're up big, 27%. If you broaden it out, Goldman Sachs says it is getting more bullish on big tech. The strategist David Kostin says we continue to expect that superior earnings growth will drive the Mag 7 to outperform the S&P 493 in 2025. That is the rest of the index, but by a smaller magnitude than in recent years. Let's bring back in BNY Wealth, Sinead, Colton, Grant. So we saw this Mag 7 spurring an almost 20% gain in the S&P 500 from the April 2nd lows. Does that continue?
Well, look, we think it does. One of the things that we were looking out for in the Q1 earnings season was any moderation in spending around tech related to AI. That is continuing. That's going to continue to boost those stocks. But let's also realize what we're seeing. They're much higher beta. They are far more responsive to any changes in market sentiment, and that continues through to even this morning.
We thought they were defensive. Remember the last few years?
Big hash hoards, cash is yielding a lot.
Are they not anymore? Because they seem to get hit by these macroeconomic trade winds just as much as everybody else, if not more.
Well, some of it is about the fundamentals, right? If you're expecting yields will be higher for longer, then that's going to have an impact on valuations. But it's also about supply chain and tariffs and, in particular, exposure to China.
When you think about the headwinds, I know we're looking at opportunities. There's actually a little bit of bullishness that the worst is over. But if you have yields higher, that means cost of financing is higher. If you have the president saying companies need to bite the tariffs, they need to absorb the costs, and margins are under pressure, at what point does this reset valuations to the point where upside becomes hard to find?
Well, look, this is where you really start to see which companies are the better run companies, right? Who's going to do a better job at having suppliers impact or have some of the impact of tariffs, reducing their prices. But ultimately, the tariffs are paid somewhere. Is it paid by companies? Is it paid by consumers? We know consumers are very worried given where sentiment measures are. What we've seen so far is businesses not making huge decisions because they don't know yet exactly where we're going to land. But it's the time where you're really going to see those well-run companies stand out, and they will surge ahead.
Are there special places or specific places that you want to look to for diversification? We were talking about, the U.S. is hard to bet against, but you do want to have more diversification than maybe you've had the last 5, 10, 15 years. Are there certain regions that you like better than others? Are there certain assets that you like better than others?
Well, we've always recommended a diversified portfolio with our clients. We've spent many hours explaining why we want to have exposure outside the U.S. But look, you clearly want to be active.
If you haven't, though, Sinead, if you just were in the S&P 500 for the last 15 years, you've crushed it.
Oh, absolutely. Yeah. Yes. And so that is, without doubt, the largest exposure. Yeah. But, as your mother always told you, you don't want to put all your eggs in one basket, right? Yes. So, look, what do we like? We think some of the defense companies in Europe look interesting. They could potentially be very big beneficiaries of the spending from the EU. We do like some of the alternative infrastructure plays like cell towers, data centers. And those are some of the areas that we like, particularly in Europe. We're still cautious on China. We just think the economic growth headwinds are very significant. And despite the stimulus package, there's just a lot to overcome in terms of the hit to consumers from not only pandemic-related depletion of spending, but also just the impact on the property sector.
But does that mean all of EM? Because last week, Michael Hartnett said there's no better place to bet this year than emerging markets.
Emerging markets, we would still exclude China. We think there were too many headwinds, both geopolitical and economic there. But outside that, yes, you've got exposure to some of the fastest growing economies, particularly when we think about India. And there are some interesting markets in Latin America, too.
So for the people that are looking at the Sell America trade today, maybe looking at the diversification a little bit more seriously, you're still looking at a DAX up almost 19% on the year. You're looking at the FTSE 100 up about 5%, the S&P 500 only up about 0.6% on a relative value basis. That trade into Europe, you've seen it. Is there much more to be had?
Well, that's the big question, and we're not sure that there is, because there's been a huge amount of euphoria so far year to date. But let's remember, Europe is still incredibly highly regulated. And when we look at productivity numbers over the last decade, productivity in Europe has essentially been flat. And we think a lot of that is to do with just the degree of regulation. So again, a lot of euphoria. We think a lot of it was triggered by just the need to rebalance at the end of the year, right? And then you sell your winners, you trim the US, and you buy the underperformers, which is Europe and Asia.
By the way, the DAX, if you are a dollar investor, is up 30% year to date.
Okay.
The same is true of like the IBEX and the FTSE MIB. Southern Europe has crushed it if you're a dollar investor, right? Because of the gains that you've got from the euro.
Yeah, absolutely. Sinead, we got to leave it there. That is BNY Mell's Sinead, Colton, Grant. We thank you so very much. We're going to also get a check here on some movers right now because we are looking at a down day on the S&P 500 generally, but not all the way around. We're looking at on a points basis, actually some of the big tech holding up. Microsoft, the biggest points gainer on the day. Interesting to see that stand out against the crowd when a lot of big tech has not been doing so well. United Health getting some reprieve. Remember, this has been a tough stock to be in throughout the year, but on a points basis, now up, but only up on a percentage basis, about 0.3%. On the downside, this is what I've been talking about here. Apple, consumer sensitive technology stocks really feeling the pain. Apple down more than 3% today. Tesla down more than 4% today. Nvidia still down about 1.2%, but maybe the pain right now not as bad as it had been earlier in the morning. Taking a look at sectors here as well, as we've been saying, yes, big tech really leading the way, but energy even more so, down more than 2%. This has been a fascinating trade this year. You could just see how broad-based the decline is here and where the sentiment stands. Healthcare is really the only place you're seeing some gains. Remember, Matt was talking about COVID-linked stocks, vaccine stocks really feeling some of that gain because of those cases seen over in the Asia region. But really, this is defensive. And Matt, we've got to see how this holds through the day. Remember, it's really a bond investors kind of day, but the stock market feeling that sell America trade too.
Yeah, absolutely. Healthcare and staples, industrials rising. Coming up, Walmart stock slumps after drawing the ire of President Trump. We'll take a look behind the animosity next as he tells them to eat it. This is Open Interest.
And it's time now for our top calls. Some of the analyst action in focus this morning. First up, we're looking at Reddit getting downgraded at Wells Fargo because of Google's AI threat. Analysts say that search user behavior is changing, and that's going to impact Reddit and all firms dependent on search traffic. Reddit really taking a bit of a hit today, down almost 4.5%, but remember, so is the broader market too taking a hit. Now next up, Netflix getting downgraded at JP Morgan. The analysts cite a more balanced risk reward following its outperformance. Now shares have gained 34% year to date. Meanwhile, Netflix just announced new seasons of Sesame Street coming to the platform. Looking forward to that. Now finally, Barclays is upgrading Williams-Sonoma, with the analysts noting that the company has already raised prices on many goods, which could provide tariff cover. Matt, I know you and I have probably been feeling that pinch given our stress shopping at the luxury food store.
Yeah, I honestly can't walk by without going in to try and get something. Sonali and I both have little cooking habits. President Trump is going after Walmart after the company hinted at price hikes during its earnings call. I also can't walk by a Walmart without going in. This weekend, Trump posted, quote, Walmart made billions of dollars last year, far more than expected. They should eat the tariffs and not charge valued customers anything. The all caps there, as you can see, are his. Meanwhile, yesterday, Treasury Secretary Scott Bessent hinted that price hikes are likely.
Understand that came from an earnings call. They, on an earnings call, because of SEC requirements, they have to give the most draconian case. So Walmart will be absorbing some of the tariffs. Some may get passed on to consumers.
For more, we're joined by Jaewon Kong. She covers big box retail for Bloomberg News. And Jaewon, it's interesting because the Trump administration in their campaign and so far this year has said that the Chinese will pay for these tariffs, not U.S. businesses or the U.S. consumer. Is that not the case?
Well, Walmart and other retailers have said for months that tariffs would result in higher prices and that they're inflationary by nature. And what Walmart said last Thursday during earnings was that they, specified when that would happen and said consumers will start seeing higher prices from tariffs soon, and that these increases will be gradual, but that they'll become more pronounced as the year progresses. And that's, we expect to hear that from other retailers as well when they report their quarterly earnings this week and in the coming weeks. No, that's exactly right. I mean, Walmart is the largest retailer in the world. They are also built to keep prices low. It's very much in their DNA, and the primary reason for why they have the scale that they have today. And it's also one of the best positioned companies in the sector to navigate through these dynamics. So if they feel like they will raise prices inevitably this year from tariffs, then I think it underscores the rising pressure for the rest of the sector. Companies that are smaller than Walmart, retailers that are more discretionary and don't sell things like groceries that are considered to be necessities.
I actually had no idea Walmart's margins were so thin until Sonali pointed it out to me on the FA screen this morning. Highly recommend you check out FA Go on any equity. What about, is Target, Home Depot, are they also looking at margins this thin? They're reporting this week, right?
Yes, that's right. So Home Depot reports tomorrow, Target reports on Wednesday. And yeah, I mean, lower margins, that's sort of the name of the game for the sector. And, that's partly why we're seeing all these companies invest in more profitable areas of the business, like advertising, marketplace, to, sort of try and offset the lower margins that their businesses have. So, yeah, I mean, they've all said, tariffs would lead to higher prices. I think Walmart last week, they are signaling that they're going to be really surgical about that, where they have some products that they're going to hold prices of, some products where instead of raising prices, they plan to sort of spread higher costs across a department or a category. So the products that are important to these retailers are going to try to really keep down and invest prices in. Other areas, we'll probably see some price increases.
Jaewon Kang of Bloomberg News. We look forward to your coverage throughout the week. And Matt, I just wanted to show you, you walk into every Walmart, but I walk into every Target. I buy a normal amount of things from there. But, you do see a real hit to the stock this year ahead of those earnings. It's down more than 27%.
I was just in a Walmart in Carlisle, Pennsylvania over the weekend buying a stroller made in China for $30 because I'd forgotten mine at a graduation. Their stock is up 7% year to date. So while other retailers have fared poorly, Walmart is still ruling the roost. But this is a key issue for them, right? With only 4% margins, how much can they eat of 30% tariffs? It's probably not going to be all of it, and they're going to pass the rest on, shockingly, to consumers.
It's a matter of a spat with the White House. Let's get a check on these markets as well before we head to break here, because we are looking at a pretty tough tape out there. We are looking at that Sell America trade continue, but not as much as we were a little earlier. About 0.5% lower, about 0.6% lower on that S&P 500, and that NASDAQ 100, 0.7% lower. The Russell 2000 really taking a brunt of that pain, Matt. Stick with us.
The faster we get to break, the more time we have with Joe.
Oh, we're looking forward to it. Joe Weisenthal joining us next. Stick with us. You're not going to want to miss it. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. Quick check on stocks, and you'll see a lot of investors are taking Mike Wilson's advice and buying this dip. When we were looking at futures, early this morning, a drop of well over 1%. Now in the cash trade, we're down, but only 0.6% at 59.24. We're still 250 points above where we were on April 2nd. Obviously positive for the year as well. So a little bit better than a stick in the eye there. NASDAQ 100 down about 0.2%, really being dragged down by the big tech stocks. You can see the dollar index also off after that downgrade by Moody's that no one really seems to care about right now. The Bloomberg dollar index down at 1225. In terms of the big stocks, the biggest, one of the biggest, I should say, not as big as Microsoft. Nvidia is down 0.8%. Tesla down about 4% right now. This is a huge weight, up 4% the gain, and earlier when it was only up 0.3, it was really helpful to the index. Now it's got to be adding a ton of points to the S&P. Moderna gaining on some COVID optimism for COVID for them, I guess. Walmart and Home Depot, we were just talking about, down. Sonali, Let's get to Joe.
Yeah, we need to bring in Joe now. Joe Weisenthal, co-host of Bloomberg's Odd Lots podcast. Of course, prolific, and lately it has been super. I'm really looking forward to your most recent one with Scott Bach, by the way.
Oh, that was a really fun one. Came out this morning. Hope everyone checks it out.
Yeah, absolutely. It's my listen to every time on my way home.
Thank you. Thank you for the plug.
Yeah, absolutely. You know, I also am curious for you to weigh in on what's happening. The Treasury Secretary just a day ago said he thinks that we can grow our way out of this deficit.
Kathy would too.
Do you think it's more likely that we grow our way out of this deficit or inflate our way out of this deficit?
I mean, look, that would be great. If we could have a really big acceleration in the rate of growth, that would be phenomenal. Look, I'm not an economist, but, we keep, that tax rates have generally been on a steady ratchet lower. They seem in the short term to provide some stimulative impulse when they get enacted, so there's some growth. But, it's not like we've seen some long-term boom in productivity, which is what we need to actually see sustained growth. I suppose at the margins, you could imagine some deregulatory moves, but it's not entirely obvious what those would be. So the idea that we're going to really kick into a higher gear of growth through some combination of further tax cuts and something else, it's hard to believe, but that would be very nice, because then it means that the interest burden becomes a smaller and smaller part of the U.S. economy without anyone having to take pain. But that would be great. I hope that happens.
The interest rate, currently the interest burden costs us like $100 billion a month, right? We pay more on interest than we do for the U.S. military every year. Tracy Alloway, your co-host on the Odd Lots podcast, often recently says it's hard to imagine how we fund this reindustrialization if we break all the capital models, right? And Mark McCormick from TD was on Surveillance this morning saying the same thing. Like, if you're going about deglobalization,
who's going to pay for it?
Who's going to pay for it? Everyone's taking their money out of U.S. assets, everyone meaning foreign investors.
Yeah, and this also dovetails with the Walmart news that you were just talking about. Companies invest when they're making a lot of money, right? When profits are going up. They hire more, they invest more, they build more plants, they build more stores, they do things that are pro-growth. When you have an administration that's telling American companies to, quote, eat it when it comes to things like the tariffs, so who takes the burden of adjustment? It's the shareholders, which is fine. I mean, no one is going to cry for longtime Walmart shareholders who have done really well. But at the margin, if it's the burden of companies to, absorb the cost of tariffs, and there's nothing public coming in to offset those profits, where does the marginal investment impulse come? Everyone would like to see reindustrialization, whatever that means in various forms, maybe in strategic industries like chips or batteries or whatever it is.
Paper packaging.
Or paper packaging. But in a time of declining profits because of the deglobalization, higher tariffs, et cetera, it's hard to see where that investment impulse comes from.
Joe, we are running out of time. We got to leave it there. It's really interesting.
Where can we get more from you, Joe?
Bloomberg.com/oddlots or oddlots on all of your favorite podcast
Wherever you get your podcasts.
Wherever you get your podcasts. A line I've said many times. Check it out.
All right, fantastic. Odd Lots there. Joe Weisenthal with Tracy Alloway. And they, I guess, have sat down with Scott Bach.
Yeah, who, of course, was very involved in the UPenn dispute. I don't know if you guys talked about that, but I'm definitely going to be listening to it.
I did not know about that. So I'm going to take a deeper dive into that. Coming up in the next hour, Steve Zelin joins us of PJT Partners on tariffs and the state of credit markets. Sounds like one of Sonali's bookings. Then Jim Millstein's thoughts on the ripple effects of that Moody's downgrade. We'll talk to him as well about the extension of the TCJA. Do we really need to do that? This is Open Interest. We are 30 minutes into the trading day. Right now, looking at drops on the S&P 500 and the NASDAQ, but really not big, considering the fact that Moody's dropped an absolute bomb. Even if you knew it was coming, still a bomb, and reduced the credit rating on the U.S. Sorry, the stage director's like doing this to me, and I don't know what. Christy, what? What are you doing? Sorry. So,
Anyways.
in any case, we could have seen much bigger drops.
Yeah,
you may have thought we would see much bigger drops.
Right.
And we're not.
Slow bleed in the bond market is really where you're seeing it. Most major sectors in the red still on the day, but the dips that you're seeing are not as bad, Matt.
Especially considering the gains that we had last week,
Yeah,
right?
it's not so
Massive
bad.
gains.
It's not so bad. Now, coming up, we're going to talk about how Wall Street is reacting to that Moody's downgrade. We're going to talk to restructuring giants Jim Millstein and Steve Zelin, who are joining us here at the desk. Plus, the view from the top macro strategist, Eric Johnston.
And happening this hour, President Trump and Russian leader Vladimir Putin speak on a phone call as Washington presses for a quick end to the war in Ukraine. Doesn't look like that's going to happen.
No. Plus, Commerce Secretary Howard Lutnick is selling his stakes in Cantor Fitzgerald, the Wall Street business group he ran for more than 3 decades. We're going to give you details on that big news in this show.
All right, earlier on Bloomberg, we spoke to Cathie Wood of ARK Invest about the U.S. deficit.
Now, one of the other things we think is going to happen, and consider the source, there is so much innovation taking place right now, technologically enabled innovation. We think real GDP growth is going to accelerate well beyond what people expect now. So this idea of growing our way out of deficits, many people are dismissing that.
Joining us now is Eric Johnston, Chief Equity and Macro Strategist at Cantor Fitzgerald. And, you know, we thought that was interesting, Eric. Cathie Wood saying we're going to grow our way out of it. Besant says we're going to grow our way out of it. Other people say maybe we're going to try and inflate our way out of it. How much does it matter, the deficit, to you as an equity strategist? Does it move the needle?
It definitely does. So if you look back the last 2 years, it's been a massive tailwind for the equity market. We've had deficits of, $2.3 trillion each year, and essentially it's like an annualized stimulus package, right? The bond market has actually handled it thus far pretty well, right? We've got a Fed funds rate at 4.5%, 10-year about 4.5%, right? So the risk premium in there is very, very small. Now we think there's a significant risk that that's going to eventually change because this deficit is unsustainable. I think growing your way out of it is going to be challenging for 2 reasons. Number one is GDP has been growing. Nominal GDP has been 7 or 8% the last couple of years. So that's been happening. And then if you look at the trajectory over the next year with tariffs, we think you could have economic growth, real economic growth at sub 1.5% for the next year. So we think this is going to be tough. Yes.
No, and I will say this whole inflate your way out of it thought was not an original thought by me by any means. Actually, David Rubenstein, co-founder of Carlyle, has been warning about this for years, that this might be your only real way out of such a large deficit. Mm-hmm. You mentioned the bond.
David Rubenstein and everyone else.
Everybody else. But, frankly, how many people have been actually warning about it, right? You think about inflation as something that's only bad for the economy, but if you want the deficit to close, I guess you can say that's maybe a benefit unless you've been saying you don't like higher rates.
Exactly right. The only thing that I think can stop this deficit trajectory is the bond market, because politically it is just not palatable. It's not something that impacts people's everyday life. And so to say we're going to cut it is just very, very difficult. But if the bond market has a big negative reaction, that can have influence on DC as the markets have had influence historically. And so I think it would take a 10-year going to, somewhere closer to the 5% zone. The 30 years obviously already above 5%, and that going, higher from here and kind of breaking through that 5.25 level might actually put pressure.
How fast does it get there? 10-year at 5%?
So, I think it has to happen. If it happens in a quick trajectory, meaning if it happens over the course of the next 1 month to month and a half, as the details of the bill start to come out, as the Senate and the House get together, that I think would cause some pause in DC. One of the other issues for the bond market is that foreign ownership and foreign participation in some of the auctions is on a small downward trajectory, and that's one of the big questions. Is this demand for U.S. assets going to start to move lower based on everything that's going on? And that's an open question.
But it's a worry. It's a headwind that we're talking about a lot. Take a look at the S&P 500 over a year or a year to date. You'll see that on February 19th, we hit a high 5 days later, 6 days later, you turned bearish on stocks.
I remember what 6,000 felt like.
Prescient call, Eric.
Thank you.
What does it take to get you bullish again? What would it take to make you really want to, back up the truck and start to buy?
It's a great question. Part of it is I think we actually start to need to see the weak economic data, right? So right now, the market is of the belief that it's actually not going to be that bad. Unemployment is going to stay around where it is. But once you start getting more of those estimate revisions, and you start to see some of that weak data as sort of opposite of what you may think, but that's where we would actually start to get more bullish. Where more of it's priced in.
That makes total sense.
We're actually seeing it.
Yeah.
Presumably lower prices from where we are right now. The multiple in a little better place, and the resetting of earnings expectations.
I mean, buy the rumor, sell the news was the first thing
right.
I learned as an intern at Tucker Anthony, 30 years ago. And
That's Tucker Anthony.
It was an equity shop. And this is like sell the rumor, buy the news is what you're saying.
That's right.
And so what would you buy? Because it looked like we were going to broaden out, and we did for a little while. Mm-hmm. But now we're back to the Mag 7 driving everything. And that seems to be a great bull case for American stocks, AI investment. Is that where you'd go?
Yes, I do think mega caps are going to outperform. That's our sort of, when you look at it relative within the market, that's the number one place that we want to be, and it's for a few different reasons. They have some defensive qualities, and they obviously have some secular offensive qualities, and some of the pure defensive sectors in the market have gotten very expensive. So I think going there is attractive. The other thing is there's been major de-risking in the Mag 7 over the course of the last 6 months. A lot of institutions have reduced that exposure, and so that's going to allow them, right, to have much more of an upward trajectory. They have a very good relationship with the current administration, which I think is very helpful. We saw that in the Mideast last week, and then I think that there are some cyclical qualities to them. However, I think that they will be more durable and resilient to any sort of economic weakness than other parts of the market.
Eric, thank you so very much. We enjoyed having you here on set. That is Eric Johnson.
Call me when you turn bullish.
Yeah, you're right across the street. You come over. Now let's get a look at some of the single stocks moving under the hood this hour. We've been looking at Nvidia all morning. We've erased a lot of those losses, though, on the day. We're only down now about 0.3% lower. They're going to allow customers to use rival chips as part of their AI efforts in a move that will further expand its ecosystem across data centers. Those shares are falling in line with the broader market. Novavax still jumping about 13%. U.S. regulators fully approved its COVID vaccine. And this one I think is fascinating, Matt. Blackstone Infrastructure is buying a New Mexico utility owner, TXNM Energy, for nearly $6 billion. It's the latest in a flurry of power deals because of that growing electricity consumption. Of course, that is a data center story, but you've seen Constellation, Vistra this year all strike significant deals. Yep. I think this is just the beginning.
Yeah, that's a trade that you have been on top of really from the beginning. Interesting to see that we're giving up some of the losses on the S&P and getting back to little change after the big rally. We only have 150 stocks up, about 350 down, so we don't have the breadth behind us, but a lot can change throughout the trading day. Coming up, Steve Zelin, global head of restructuring, and a restructuring trade is another thing that Chanel's really been on top of. And Special Solutions Group at PJDT Partners, how the Moody's downgrade could weigh on credit markets in the long term. That's next in our Wall Street Beat. This is Open Interest.
U.S. Commerce Secretary Howard Lutnick selling his stakes in Cantor Fitzgerald. He's passing ownership to his children and outside investors, as well as cashing out hundreds of millions of dollars. Lutnick ran the group for more than 3 decades. He started at a very young age there. Joining us now with more, Bloomberg banking reporter Todd Gillespie. Actually, I should be focused on Howard Lutnick, but instead I'm equally focused on Josh Harris getting into this deal.
Me too, yeah.
Right?
Yeah.
I mean, it's a really interesting move to see 26 North make this big of a move this early on.
Absolutely right. I mean, Josh Harris started, co-founder of Apollo, started this alternative investment firm just in 2022. And now, it's been a tough time for deals. And now he's suddenly making quite a big a big deal in the financial services sector in the US. He's one of two outside investors. His firm is one of two outside investors, along with the founder of Oak Hill Advisors, where Brandon Lutnick also used to work before he started at his father's companies. So there's a long history, long relationships there between the group and these new investors.
Brandon Lutnick stepping out into his own.
I mean, it's a really cool story in that sense. The Succession story, the rap single, which I haven't listened to, but I'm sure it's amazing. What about the cash in? I mean, how much money is Howard Lutnick going to make on this deal? And does he get any special tax treatment since he's working for the government?
Yeah, I mean, it's quite hard to say fully because what we're talking about here are like three distinct entities. You've got a private parent company which has shares itself. You've got two public companies as well in which that private parent company has controlling stakes, and there are multiple different places where Lutnick has divested here, and obviously only the public stake sales you can value here. We're talking north of $300 million.
But this administration is so focused on transparency, Todd.
Yeah, well, exactly, Matt. It's still a little bit difficult on Wall Street when you've got a massive private empire. And Lutnick, we know, is one for all sorts of different companies and legal entities. His disclosure filing earlier this year disclosed roles that he had in more than 800 different legal entities. So this is a man. Let's just say this process probably wasn't that simple for whichever lawyers were drafted in to help do this.
Todd, we appreciate your time. Thank you so very much for keeping an eye on all of it for us. That is Bloomberg Todd Gillespie. It's time now for the Wall Street Beat, because investors are really weighing in here on that Moody's downgrade of the United States. So joining us now, Steve Zelin. He's the global head of restructuring and special situations at PJT Partners. You've been at this a long time, and the 10-year today is not only at 4.5% on the heels of that Moody's downgrade, the 30-year closer to 5%. We're also now having strategists thinking that you could hit, I mean, this I thought was an extreme view, but you could hit 10-year at 5% this month with what's going on in Washington. Now, these fluctuations in long-term interest rates, how is that having a ripple effect? How does the U.S.'s credit standing ripple into corporate America?
Well, I spend my time in the high-yield markets, as you know. And first of all, thank you for having me, by the way. I spend my time in the high-yield markets, and those markets price risk. So those markets will look at the adjustments, look at alternative investment opportunities, and they'll make their decisions where and how to price the risk that they finance into. Interestingly enough, though, it will make refinancings more expensive to the extent the ripple effects are increasing the overall yields in the markets.
Well, how much would this increase the overall yield? I think one thing that was problematic about the Moody's downgrade, it's a moment in time for a lot of people, but for someone like you, you're really seeing a direction of travel here, that higher for longer narrative. 4.5 in a few years, is that going to look cheap?
Well, it could. It's hard to say, and I won't predict, but we do know as the market had thought yield curves would come down early in the year. Those expectations shifted, and I think now the repricing of the treasuries on the backs of the downgrade will just have to work their way through the markets. But it really is company by company, case by case specific, and it's unique to the industry, the leverage, the cash flow profile of those companies that are more highly levered.
The Moody's downgrade felt big, but not unexpected, right? What are the catalysts that you're watching out for, that are most important to your business, to the rates that you watch?
Well, what's great about our market is it's really, really efficient. The markets tell you where to look when there's stress. Beyond just yields, you can look at risks of downgrades of individual companies. You can look at spreads. You can look at just industry trends and so on and so forth. So this kind of catalyst tells me that those who were struggling before are not going to be excited about the opportunity of having to refinance their balance sheets at now potentially higher rates. And they may have to look to alternative means to kind of deal with maturities.
Are you watching, for example, how much progress is made on this one big, beautiful bill? Are you worried about the debt ceiling? Are you looking at all of that stuff? Or is that bigger picture?
Tariffs.
Tariffs, exactly. Is that bigger picture not as important to the individual?
The answer is yes, 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 and yes, but it manifests itself in just the individual risk assessment of an individual company. How are they dealing with? How can they deal with, and will they not be able to deal with potential for increased costs, potential for declining revenue, and potential for an increased refinancing of maturities that are coming due?
You know, there's a function on the Bloomberg terminal, BCY Go, and it shows you how many bankruptcies you're seeing and where you're seeing the bulk of them. Consumer consumer is really where it hurts. And you have the president saying to Walmart, you got to eat the tariffs, right? They're razor thin margins at places like Walmart, which is the king in the room. What does this look like across
4% operating margin.
the industry?
Not much.
Right. I mean, if you can imagine that for Walmart, then what does everybody else look like?
Well, look, not everyone is created equal in terms of their ability to deal with the uncertainty. Leverage starts. Leverage is where you look first. But pressure on pricing, pressure on the consumer, all does not lead to an outlook, including the uncertainty around the long-term tariff implications. It's hard to plan in 90-day cycles and make 2 to 3 year investment decisions based upon what will happen in the next 90 days. So the uncertainty in the markets are certainly impacting those companies that we look at who may have some stress on
Yeah,
their
it's
balance
interesting.
sheet.
You're seeing industrials and healthcare also taking a bigger and bigger proportion of that pie of bankruptcies too.
Right. I have to work on my BC wine good because like I don't make
I'll help you
anything of it.
after
It's
the
all
show.
green here. Are you worried is the bottom line, Steve? You know, keying off of Sonali's point that, you know, this big behemoth Walmart with only 4% margins, they're going to have to pass on some of the costs. What about the medium-sized businesses that make up the bulk of American hiring and
who's
CapEx?
calling you?
Right. So clearly the stress on the smaller, more mid-market-y type companies will be experienced first. The bigger companies have a lot more levers to play, probably a bit more flexibility in what they can do. But not all bankruptcies are created equal. Bankruptcies, you know, are here to fix good companies with bad balance sheets, but they also may be used for companies that just no longer have a business model that works. And so you just can't look at bankruptcy in general. You need to look at the underlying industries, and you will see that stress growing on the smaller markets. The calls we're getting are from companies who are not yet sure what the next 6 to 12 to 19 or 18 months will bring. They tend to be a bit larger, and the decisions about where to invest, how much to invest, how they can finance their balance sheet, will the capital markets be there? All the stresses they're focused on.
You know, it's interesting. In a prior conversation, you mentioned that actually bankruptcy is, you and I talked about those rise in bankruptcies slowly ticking higher. It's actually not seeing a lot of stress. You're seeing stress elsewhere. What does it look like? Paint a picture for the companies that are facing these tariff pressures, calling you, looking for solutions. What does that look like?
Well, the earlier they begin to think about the pressures they're facing, the more options they will have. Everyone looks at bankruptcy as being the measure of the underlying stress, but there are really tools that are available to these companies that they look 2 to 3 years before they're facing a maturity, facing a squeeze in their cash flows. And there are markets that are available to access that will help these companies avoid chapter in a way to navigate what hopefully is a near-term and not medium and long-term uncertainty.
This is why we want to have you on, right? Because if you look at bankruptcies over the last 20 years, you know, we're climbing, but we're not near historical highs. And I guess our thought is maybe it's the restructuring people right now that are getting super busy. Like if we could graph your call log, how does it look right now?
Just like hanging out outside of PJT.
It looks good, but I will tell you, restructuring has a connotation to it that equals bankruptcy. That's not the case. You may see bankruptcies slowly increasing, but not approaching any near the levels you saw a few years ago. But the default rates are kind of hanging tight, and that's because companies are actually fixing balance sheets without the need to use chapter. There's capital available, there's market opportunity, there's credit document flexibility. The earlier you deal with it, the better off you'll be. And the bankruptcies that we're seeing may just be an acceleration of those companies that were probably weakened anyway, or unfortunately more mid-markety, which they don't have the same level of capacity to deal with stress in the near term.
Steve, we got to leave it there. We thank you for joining us here in studio. Just a little bit of color on what's going on in your world. That is Steve Zelin of PJT Partners. Moral of the story, as we've been talking about, maybe not a screaming issue, but certainly a slow bleed in the face of higher rates.
Right. Well, and maybe there's really a silver lining there, right? In that.
Are you making fun of me?
No, I'm not. In that Steve is saying like that the markets are better prepared for this now than they have been in the past, and there are tools that can be used. Let's get a check on what's going on in the markets, in the stock markets right now. In terms of the equity indexes, we're looking at losses, but only 0.25% on the S&P 500, 59.43. You would have loved to hear that on April 3rd, April 4th, April 7th. So we're much higher. 250 points, almost 300 points higher than we were on April 2nd. The NASDAQ right now down, but only 0.3%.
It's been negative sentiment this morning, but the way things are going, you could end positive on the day.
Absolutely. We'll see when Romain Basak anchors the close. But this, currently, right now, this is Open Interest. All right, let's get a check on what's going on in the market, getting a dynamic picture from the move screen on the Bloomberg. We have been seeing losses get smaller and smaller, and you can see that Microsoft, United Health, Nvidia are all adding points to this index and helping us avoid falling further. However, the breadth is not for us here. We're only looking at 140 stocks up, and we're seeing 360 down. So the breadth really to the downside. Also, all sectors on the S&P 500 are falling. We had seen healthcare gaining on optimism that some COVID producers are going to get more business. However, that's now lost. So consumer staples, healthcare, industrials, these are the smallest losers, I should say, because they're so defensive, Sonali. So it's not a great day for stocks, even though we only see tiny losses.
Yeah, and Matt, I have some breaking news here. According to Reuters, Nippon Steel, and this is the deal that never ends, Nippon Steel will invest $14 billion in U.S. steel if Trump okays a deal. We're keeping an eye on that. But coming up next, stick with us. There's more ahead. We're going to bring in Jim Millstein. He is Guggenheim's co-chairman and former Treasury official about the downgrade.
The kindness of strangers have been basically funding U.S. twin deficits. That is now a challenge. There's a trust problem, there's an uncertainty problem, there's a growth problem, and there's also a valuation problem. The catalyst is the rest of the world now has other places to invest. They're stimulating their economies. Their equity markets are essentially undervalued. And I think a critical thing here is what we're doing is we're unwinding globalization.
That was Mark McCormick of TD Securities, and stocks are still lower alongside longer-dated treasuries after Moody stripped the U.S. of its top credit rating. The move is reinforcing Wall Street's concerns about a ballooning budget deficit. And joining us now, Jim Millstein, Guggenheim Securities co-chairman. Jim worked as the chief restructuring officer of the Treasury Department between 2009 and 2011, and he helped recapitalize and restructure troubled companies that had been bailed out by the government. We're seeing different types of trouble these days, Jim, and you have been very much keeping an eye on not only the health of the U.S. government, but the ripple effects that a downgrade means. How do you explain how the rest of America might feel now that the health of the U.S. government is also compromised? Is that fair?
Well, I mean, the Moody's downgrade was sort of inevitable, given the state of the budget deficits that really have been going on now since 2000. For the last 25 years, you know, the Congress has really failed to get its house in order, but it's getting worse now. And Moody's downgrade followed. S&P downgraded in 2011 during a big debt ceiling dispute between the Obama administration and the Republican House. Fitch followed in 23 for the same reasons that Moody's has cited. And, you know, and Moody's kind of, what took them so long? Because our fiscal stats are just all out of balance, right? We're running a deficit of $2.5 trillion now, and it threatens to widen, to become worse.
Right.
And our, you know, debt to GDP is now, the gross government debt is larger as a matter of stock than the actual the economy itself. So as the deficit is growing faster than the economy, and therefore deficit is growing faster than our tax revenues, and it's threatening to expand unless we have what, you know, economists call a fiscal consolidation plan, unless we raise revenues and reduce spending to close the deficit.
This is something I'm wondering about today. In 2017, when Trump initially passed the TCJA, everybody on the left and a lot of people in the center said, this is just a tax cut for the rich, and criticized it. Now, Democrats seem to be saying we need to extend this. Like, why don't we just kill the TCJA or let it, you know, good night this year?
Well, the talking point is it would be the largest tax increase in American history, right? Because if it isn't extended, then all of the rates go back to where they were in 2016.
That's a talking point, but I mean, what does it mean for each individual, right?
There's truth to it. The tax cut was across the board. Obviously, if you're paying more in taxes, you've got a bigger dollar benefit from the tax reductions. But today, you we definitely have to raise taxes. And the problem that the deficit hawks on the Republican side of the aisle, the guys who held the bill up last night, but apparently have now found some reason to support it and let it get to the floor. The problem the deficit hawks have on the Republican side is they have one hand tied behind their back. The only thing they can do is cut spending, because they've all taken like a religious pledge never to raise taxes. And
but to be clear, this one big, beautiful bill is going to add $3.3 trillion to the deficit if everything is temporary, is kept temporary. And if they extend things permanently, it's going to add $5.2 trillion to the deficit.
But it's worse.
Right.
Because just imagine, these projections are all made on a 10-year basis.
Yeah.
And they assume, consistent economic growth. So just imagine the Trump tariffs because of the uncertainty and the variability, and is it 145% yesterday or 40% today on China? Imagine we have a recession. In the last 5 or 6 recessions, the budget deficit actually blows out because tax revenues go down and spending increases, so-called automatic stabilizers. So what today is 6.4% of GDP as a deficit, $2.4 trillion deficit, could easily expand to $4 trillion if we had a recession. So they are risking a fiscal disaster.
At which point we'll be at 125% debt to GDP,
It's,
or
but
130%
but
debt to GDP.
The debt to GDP comparison really isn't the most important one, right? We could sustain the level of debt we have if we can bring our deficits down and therefore get our interest rates down. The real problem, as you were talking to Zelin earlier, the real problem, as with a company, the country has, is the interest burden. So today, the interest burden on the federal government is consuming 18% of our revenues. Our total revenues, 18% of them are going to pay interest. That's going to be the largest spending category on the federal budget in a year.
Over $1 trillion a year.
Bigger than Social Security, bigger than Medicare.
Bigger than the military.
Bigger than the military. It is, and it's growing as the deficits grow.
The amazing thing to me, too, and to be fair, we've seen the deficit grow under Republican administrations and Democratic ones. This has been a slow bleed for many years.
A fast bleed.
A fast
for many years.
Yes.
Yeah.
We just keep bleeding out. Now, if we look at the tax bill, you were making this point earlier that if you don't raise taxes, you just have to cut spending. And these Medicaid cuts, for example, what does this look like going into the midterms, ultimately?
So let's talk about the things that the reconciliation bills on both sides of the House, on both sides of the Congress, are focusing on cutting, are basically programs where the federal government transfers money to the states. Education, transportation, healthcare. These are not direct transfers by the federal government to individuals, but transfers by the federal government to states who then administer the programs. So these cuts that they're talking about are going to cause fiscal problems at every one of the states. The average state in the United States gets 35% of its revenues, its total revenues, from the federal government. So when you cut Medicaid, you're forcing the states either to cut the program back or to raise their own taxes to pay the same level of benefits they're currently paying out, to put more state money into the programs. You might argue that's the right thing from a federalism point of view, but the result of these spending cuts at the federal level are going to create real fiscal pressures at each of the states. And this is one of the reasons, I think some of us are skeptical they can actually get this done, is it's worse for the red states than the blue states. The red states actually depend more on the federal government's
They are
largesse.
wagon riders, not wagon pullers.
They depend more on the federal government's largesse than the blue states do. So the Republicans have a very narrow majority in the House. And, these spending cuts are going to really hit all the states, but the red states particularly hard. Even look at what the cuts to the Inflation Reduction Act's various tax credit programs for renewable energy, EVs, battery plants. The Biden administration was thought they could protect those programs by targeting the investments in battery plants and in chip plants in red states. So when these subsidies that are proposed to be cut hit the House floor, you're going to see a bunch of red state Republicans going, oh, wait, not so fast.
Wait, so I want to go back to something you were saying earlier, that you look at the cost of borrowing for the U.S. government, and then you add a multiplier effect on top of that for the rest of the country, for corporations.
Right.
You made this point once to me before, that you cannot be rated domiciled in the U.S. at a rating above the U.S. government. This is part of the problem, right?
Well, no governmental unit can be rated higher than the federal government. So, the states and the municipalities who issue tax-exempt debt, this is all going to have impacts on them, because at the end of the day, their sovereignty depends, largely on the sovereignty of the United States.
It's a stone rolling down the mountain.
But for corporates, sure, there's always a spread to the 10-year Treasury. So if the 10-year Treasury is, as it is slow, the yield is slowly moving up, not really because of the Moody's downgrade, but really because of the imbalance in the federal government's finances and the huge amount of deficits they have to finance. And because the Yellen Treasury Department and now Scott Bessent's Treasury Department is funding short rather than long, you have huge refinancing obligations as that short-term debt has to be refinanced. So this year, in the next 12 months, Bessent is going to have to refinance $8 trillion worth of the federal debt and finance a $2.5 trillion budget deficit. That's a huge supply of treasuries coming into the market. So one expects that, that the risk premia that investors are going to impose on the purchase of treasuries is going to go up because of just how out of balance we already are, and what this new tax bill, reconciliation bill, may do to future deficits.
It reminds me of that double-line thought experiment. Do you buy Microsoft bonds or the U.S. government bonds?
Microsoft.
Yeah.
Microsoft. It's crazy. It's crazy.
It's a fascinating conversation. Jim, always great to have you here. Thanks so much for joining us.
Thanks for having me.
Jim Millstein there of Guggenheim Securities. Coming up, Medicaid coming under attack, as we were just talking about in the president's tax and spending package 1B3. We'll get reaction from Angie Frank. She's the CEO of Kalderos. Next, this is Open Interest. GOP leaders agreeing to faster cuts to Medicaid as part of the president's tax and spending package. This comes just 1 week after the president signed an executive order to lower prescription drug prices here in the U.S. Let's get a read on all things healthcare with Angie Frank. She is the CEO of Kalderos. Kalderos is a data and analytics company that created the world's first end-to-end drug discount management platform. That's a lot of words that don't make so much sense to me. Angie, what exactly do you do at Kalderos?
Well, thanks, Matt. Good to be here. Kalderos did develop the first end-to-end drug discount platform, and this is all about the complexities that exist in our pricing system from the point where manufacturers make drugs to the point where they get to the patients. There's a lot of players in the mix. Each one of those players have to make money on the complexity of the drug supply chain. And we help simplify that by bringing technology to identify where the wrong price may be applied or the wrong discount may be applied. And this is really important for manufacturers and for all Americans, because if we're overpaying or there's waste in the system due to this complexity, what it's doing is it's impacting what we put in the top of the funnel from an innovation perspective. So it impacts manufacturers' profitability and their margin, and that impacts negatively their investment in innovation. And ultimately, that hurts all of us.
So is Kalderos then a platform that I can use as a consumer, or is it a platform that maybe my doctor or my pharmacy wants to use?
Actually, manufacturers use our platform to make sure that they are paying the right price and applying the right discount for each individual patient.
Let's have you weigh in then on the broader plan here by the Trump administration. There are a lot of ways that drug pricing is being targeted, but then you also have the Medicare plans that you're seeing for cuts in terms of where the tax bill is headed. How do you take all of this holistically and what it'll mean for Americans and the costs that they have to pay for drugs?
Well, it's such a complex problem because we have such a complex system of payers, insurance companies, GPOs, PBMs, all sorts of players, from the point where the manufacturer manufactures drugs to the point where the patient receives that medication. There are a lot of hands in the pot, and all of that rises complexity. It grows complexity, and complexity increase costs. So we really work to streamline that and identify where the waste occurs in that process. And that should benefit patients, because if we can eliminate and simplify and reduce complexity and help manufacturers work more closely and directly with the providers, we can eliminate some of the complexity in the middlemen. And that, we all know, when complexity is reduced and direct business models are put in place, it is better for consumers. We pay less.
You know, one thing I'm really concerned about, actually, is when you look at the tariff strategy by the Trump administration, this idea that you want more to be made here. On one hand, you could see why all Americans would want that. However, a lot of the generic drugs in particular are certainly not made here, and I really wonder what it would take to make that happen. In the near term, do you think that there's going to be a significant impact to the most low-price drugs that are needed for so many Americans?
I think the approach that the administration is taking, working very closely with manufacturers to bring more manufacturing onshore in the U.S., is all positive, and those are all good conversations that I know leaders of drug manufacturers are having. With that said, you know, we're pretty tariff agnostic at Kalderos. That there really isn't a big impact in terms of what we're doing. But again, I think the more control, the more ability for manufacturers to work more closely with the people that are getting the meds directly to the patient simplifies, it eliminates complexity. And when you simplify and eliminate complexity, you improve costs. It'll be cheaper for Americans. At the same time, if we can do more to drive transparency and understanding of what actually is happening in the drug supply chain, I think that also benefits Americans.
Angie, great to have you on the program. Thanks so much for the explanations and the intel. Angie Franks there of Kalderos, where she is the CEO. Coming up, President Trump's phone call with Russian leader Vladimir Putin is underway. We are live in Washington with the latest next. This is Open Interest. President Trump's call with Russian leader Vladimir Putin started a few minutes ago. Let's get the latest now from Balance of Power co-host Kayleigh Lyons. And Kayleigh, from what I'm hearing, it seems like Russia may have the upper hand in these negotiations, may not want any kind of real peace deal. And President Trump is going to later have to go to European leaders and ask them if they can't stop supplying weapons to Ukraine. What do we expect?
Well, Russia does think it does have the upper hand, Matt, according to sources familiar that Bloomberg has thought through the thinking with. But the kind of notion here is that something tangible needs to potentially happen from this call or the preceding call that will happen with Vladimir Zelensky after President Trump speaks with Vladimir Putin, because Trump is starting to get frustrated. According to people around him, he is not satisfied with what is seen as Russia kind of stalling on reaching some sort of ceasefire agreement, and he is open to the idea of implementing further sanctions on Russia if necessary, if he doesn't feel that Russia is meaningfully playing a role at the table here. So it'll be interesting to look through the readout, which the White House press secretary has promised will come after this call has concluded. She said that when it comes to sanctions, everything is on the table. But it's also possible that the U.S. grows weary of the process here. J.D. Vance, the vice president, who was in Italy traveling for the last few days, told reporters that it is still possible that the U.S. walks away from this if there is no progress. Though I would also note that J.D. Vance, after his very hostile interaction with the Ukrainian President Volodymyr Zelensky in the Oval Office back in February, had a much friendlier interaction with him at the Vatican yesterday, the two smiling, shaking hands, kind of sending further signals that the U.S. may be warming up more to the Ukrainian side than the Russian side here, though clearly the White House is still expressing frustrations with all sides as it wants to see an end to this conflict. And it's not clear that the deal is there to be made at this time to make that happen.
I was wondering about that meeting. You think about J.D. Vance and his relationship to Zelensky after that exchange. How is the balance of power, so to speak, here changing, Kaylee, between the U.S., Ukraine, and the U.S., Russia? You mentioned that there might be a little bit of a shift here on both sides, but is there a turn?
Well, there certainly has been a warming of relations between this administration and Ukrainian President Volodymyr Zelensky, who has changed his own tone in trying to concede more to what the U.S. actually wants to hear from him in terms of willingness to be agree to a ceasefire. Ukraine has been calling, along with the U.S., for an immediate 30-day ceasefire, and it is Russia that is not yet agreeing to that. Russia that has been criticized by President Trump, who has asked Vladimir Putin directly to stop attacks on Ukraine, the likes of which we saw again over the weekend with a massive drone strike that was conducted. And you are just starting to hear a harshening of language, both from the likes of J.D. Vance, but President Trump himself, when they talk about the Kremlin and Vladimir Putin, which is why this call is going to be so crucial to see whether or not President Trump still feels that Putin is someone he can relate to, someone he can do a deal with and make this happen. Because, of course, he promised that he could do this in day one of his administration. And here we are in mid-May and still nothing to show for it.
Kaylee, any progress on SALT?
Not on SALT specifically. The conservatives in the House, Matt, have gotten something of a promise from the Speaker to get more of what they want, which with a fast forwarding of new restrictions on Medicaid, as well as rollback on clean energy credits from the Inflation Reduction Act. But to this point, there is no deal to get that SALT cap higher than $30,000, though the tax bill was able to advance out of the Budget Committee overnight. It is facing with a rules vote on Wednesday, and there is still a lot to sort out if they want to get this full thing to the floor and hopefully pass, as the Speaker has suggested, by the Memorial Day recess. But the SALT caucus to this point has not actually been offered anything new in terms of a tangible suggestion from Speaker Johnson about where that cap should escalate. He's contending with moderates, conservatives here, and there's still a lot of work that needs to be done, Matt.
All right, well, then balance of power continues to be must-see TV. Kaylee Lyons is the co-anchor of that program. Kicks off on Bloomberg Television at 1 o'clock. You can see it then, the late edition at 5 o'clock. I recommend both hours.
I love that that's what you needed to say before our show. You're very competitive a bit with other shows, but balance of power.
I am, but that's, I mean, I feel like it's a different thing, right? It's all
like
politics.
Your other wife. I'm getting jealous.
It's a very good show. It's a very good show.
Anyways, you know, it's interesting. We are looking at the S&P 500 still keeping on to its losses for the day, Matt. Want to take a quick check on these markets before we let you go. Barely any sector in the green today, but we'll keep an eye. The day is young. And Matt, we have a few amazing things coming up tomorrow. Yeah, we do. We have Bloomberg's Michal Hussein speaking with Elon Musk from the Qatar Economic Forum. We'll bring you that. Plus, Ethan Devon of Moneta, David Kostner of Goldman Sachs, and Josh Easterly of 6th Street.